Have you ever, wanted to quickly get the real story behind a company's financial performance, understanding what's actually driving things without getting totally bogged down in jargon? Well, that's exactly what we do here on the Deep Dive. Our whole mission is to take all this complex info, sort through it, and give you clear, actionable insights straight up. Today, we're tackling financial reports. Yeah, sometimes they seem intimidating, but we're going to tune these numbers into a story that makes sense. We're doing a deep dive into Tube Investments of India Limited TII. They're a pretty big deal within the 124-year-old Murugappa Group. And our source material, it's their brand new unaudited standalone and consolidated financial results for the quarter ending June 30, 2025, just came out August 1st. So our job for you today is to pull out the really key takeaways from these results. What do they actually mean for TII, their strategy, their health, and honestly, why understanding these details behind the headlines really matters? Let's jump in. Okay, so to really get a grip on TII's performance, let's start with the big picture. The top line numbers for this quarter. So standalone, that means just TI itself, the core company, the revenue edged up. It's at just over 2,000 crore. So 2007 CR, actually, that's up from our 1,960 crore same time last year.
Decent growth there.
Yeah, and their profit before tax, PBT, that also saw a nice little bump, climbed to Rs 222 crore from Rs 208 crore.
Okay, so that's a solid baseline for the main operations. But then, when we zoom out to the consolidated results, that's where you include all the subsidiaries, the joint ventures, everything.
Right, the whole family picture.
Exactly. And the picture gets way bigger. Consolidated revenue, it jumped to over Rs 5,300 crore. That's a pretty significant leap from about Rs 4,500 crore last year.
Wow, okay. Big jump.
Huge jump. But here's where it gets interesting, maybe connects back to the standalone picture. If we look closely, the consolidated profit before exceptional items and tax, it actually dipped slightly.
Oh.
Yeah, it went from Rs 470 crore down to Rs 449 crore. So you've got this really strong revenue growth overall, but a little bit of a pullback in the consolidated profit. Kind of makes you ask, right, what's driving that tension underneath?
That is a great question. And I guess to really understand that, we need to peel things back a bit, dig into the individual business segments, but on that standalone basis first. This is where we see the different engines, So let's start with engineering. Revenue looked pretty strong, almost Rs 1,300 crore. That's up from Rs 12,265 crore. But interestingly, the PBIT, profit before interest and tax, for just this segment, it slipped a tiny bit. Rs 153 crore down from Rs 157 crore.
Okay, yeah, that's exactly the kind of thing you notice.
Right, so revenue's up, profit's slightly down. What's the first thing you'd be looking for in the full report to figure that out?
Well, immediately you think, okay, revenue's growing, but profitability per rupee earned is slightly less. So are there input costs up?
Could be.
Or maybe there's some pricing pressure in that specific market. Or maybe a shift in the product mix within engineering. You'd really want to look at their gross margins for that segment, maybe operational expenses too, just to see if it's a temporary thing or something more structural they're dealing with.
Makes sense. Okay, moving on. Metal-formed products. That look pretty steady.
Yeah, steady growth. Revenue around Rs 366 crore, PBIT at Rs 37 crore. Consistent, reliable, not flashy, but solid.
Right. Now, mobility. Okay, this segment really caught my eye. What jumped out at you here?
Oh, absolutely, the PBIT. The profit jump in mobility is the real headline within the segments, I think.
It was pretty dramatic, wasn't it?
It really was. Going from just Rs 2 crore in PBIT last year to Rs 7 crore this quarter, that's like a 3.5 times increase.
Wow.
It signals some serious momentum. Maybe they've hit some operational efficiencies, or maybe the market's really responding well to whatever they're doing there, especially, thinking about their clean mobility stuff.
TCMPL, yeah.
Exactly. Yeah. It really suggests this could become a much bigger driver for them going forward. It's not just a small increase. It feels significant.
Definitely one to watch. And lastly, the other segment. Revenue dipped slightly, but PBIT actually improved a bit.
Yeah, Rs 17 crore PBIT from Rs 15 crore. So even with slightly less revenue, they managed profitability better there, maybe some cost control, or focusing on higher margin activities within that others bucket.
Okay, so that mobility PBIT surge is definitely the standout on the standalone side. Now let's zoom back out, like you said, to the consolidated results, including the subsidiaries, associates, JVs, the whole group picture.
Right.
And this is where you really see the scale of the Murugappa Group's engineering and industrial side. I mean, you've got massive contributions from companies like CG Power and Industrial Solutions. TII owns, what, 58%?
Yeah, controlling stake.
Yeah.
And they're a powerhouse right now.
Clearly. Their consolidated revenue alone was nearly Rs 2,900 crore. That's a huge jump from about Rs 2,200 crore last year.
Massive.
And their PBT, CG Power's PBT, grew substantially too, Rs 364 crore.
Mm-hmm. Up from 336.
So that subsidiary is clearly a major engine driving that big consolidated revenue number we saw at the start.
Absolutely. It's fascinating, isn't it? How the strength of a key subsidiary like CG Power can really lift the entire group's top line.
Right.
And even though, as we mentioned, the overall TII consolidated profit before exceptionals dipped a tiny bit,
Right.
the fact that CG Power is growing its own profit, its PBT, is critical. It shows resilience.
Right.
And you see it with Shanthi Gears, too, another subsidiary. TII owns about 70% there.
Okay, how did they do?
Their revenue was actually down slightly Rs 135 crore from Rs 139 crore. But importantly, their PBT increased to Rs 31 crore from Rs 29 crore.
Interesting. So less sales, but more profit.
Exactly. Which points to really good cost management or maybe a better product mix within Shanthi Gears itself. So it just highlights the diversified strength. Even if one area faces a bit of a headwind, like maybe Shanthi Gears revenue, another like CG Power is surging. And even Shanthi Gears improved its bottom line. It paints a picture of a well-managed, resilient group.
That makes a lot of sense. Okay, so we've seen revenue growth, some profit nuances between standalone and consolidated, strong subsidiary performance. What does all this actually mean for the company's financial health? Like, how stable are they?
Well, the numbers here tell a really positive story. Stability, efficiency. It looks very strong.
Okay, like what jumps out?
The debt levels, or rather the lack of debt.
Yeah. I saw the debt to equity ratio. It's tiny.
It's incredibly low. Standalone, it's 0.02, consolidated 0.05.
And last year it was 0.10 for both. That's a big drop.
Huge drop. Basically tells you they're hardly using any borrowed money compared to their own capital. They are overwhelmingly self-funded.
So very low risk from debt, though.
Extremely low risk in that sense. It makes them super resilient if, interest rates go up or the economy gets shaky. And it gives them enormous flexibility to invest or make acquisitions without taking on big financial risks. They're not shackled by interest payments.
Right. And I saw the coverage ratios looked amazing, too. Debt service coverage.
Phenomenal improvement standalone. It jumped from about 23 times to nearly 40 times.
40 times.
Yeah. It means their operating income can cover their total debt service obligations 40 times over. That's just incredibly comfortable. Consolidated is also very healthy at over 12 times.
And the interest service coverage ratio, similar story.
Even more dramatic on the standalone side, it went from about 26 times to over 52 times.
52.
Wow. Consolidated also strong, up to over 24 times. It just screams financial stability.
Yeah.
When you can cover your interest payments that easily.
It means you got plenty of cash flow.
Exactly. Loads of cash flow left over after servicing debt, available for operations, for investment, maybe for shareholder returns down the line.
And their net worth keeps growing too, right?
Absolutely. Steadily increasing. Over Rs 5,300 crore standalone and crossing Rs 8,000 crore consolidated now.
So the underlying value of the company is just getting stronger.
Precisely. It's like building a bigger and bigger financial cushion. Retained earnings, a stronger asset base, it all points to fundamental resilience and a solid platform for growth.
And the margins looked okay too, operating and net profit.
Yeah, pretty consistent. Standalone operating margin held steady at 12%. Consolidated actually improved from 10% to 12%.
Like, that was a nice improvement there.
And consolidated net profit margin also ticked up from 5% to 6%. So yeah, it suggests they're managing costs effectively and running things efficiently overall. This kind of financial muscle really sets them up for what we should probably talk about next, their strategic moves.
Perfect segue, because yeah, you can't just look at the numbers in isolation. You got to see what they're doing strategically. Their investments, acquisitions, that's what shapes the future. And a big one seems to be this TI Clean Mobility Private Limited, TICMPL.
The EV venture.
Right. TII put in another Rs 500 crore into it, subscribing to these Series B CCPS, compulsorily convertible preference shares.
Yeah, that's a mouthful.
It is. But here's the slightly confusing part I saw in the notes. Even though it's TII investing money,
Right.
for accounting purposes, they have to treat these CCPS as a financial liability on the consolidated books for now. And they even reported a fair value loss of about Rs 137 crore related to it this year.
Okay, yeah. That sounds counterintuitive, right? Investing money but booking a loss.
Exactly. How should we understand that? Is it a bad sign for the investment?
Not necessarily, no. It's really important to unpack that. See, CCPS are designed to convert into regular equity shares later on, usually based on certain milestones or timelines. The liability classification and the fair value loss are often just accounting requirements based on the specific terms of those preference shares and current market valuations for that type of instrument. It doesn't mean the underlying business, TIC-MPL, is actually losing money in its operations, or that TII thinks it's a bad investment.
Ah, okay. So it's more about how accountants have to value these complex shares on paper right now.
Pretty much. Think of it as a temporary accounting treatment reflecting the nature of the share, rather than a red flag about the venture's potential. The fact they pumped in another 500 crore shows serious commitment to clean mobility. The carrying value is still huge, like RCIS, 2,385 crore.
Got it. That makes more sense. Okay, what else strategically? They bought a company called KCL Tech System last quarter, right?
Yeah, KCL Tech System India Private Limited. They took a 67% stake for about R62 crore.
And they make aluminum tubes for car air conditioning systems, HVAC.
Right, for the auto segment.
What does that kind of acquisition tell you? Seems quite specific.
I think it's a smart, targeted move. It strengthens their position in the whole automotive supply chain. And think about it with EVs, thermal management, keeping batteries cool is even more critical than just passenger comfort. So HVAC systems are evolving and becoming more important.
Ah, good point.
By bringing KCL in-house, TII isn't just getting a component supplier. They're embedding themselves deeper into that future auto tech landscape. It adds value to their offerings for both traditional and next-gen vehicles. It feels like future-proofing.
Okay. And CG Power made a move too, something about RF components.
That's right. CG Power, the big subsidiary, acquired the radio frequency components business from Renesas Electronics America. That was about RS 285 crore, also last fiscal year.
RF components, that sounds quite high tech.
It is. It ties into another strategic development. TII identified a whole new business segment last year called semiconductors.
Oh, really?
Yeah, covering OSAT, that's outsourced semiconductor assembly and test, and this RF components business they acquired. They actually carved these out from the other segment.
Wow, okay. So semiconductors, RF components, clean mobility, specialized automotive parts, it really shows them pushing into new tech-focused areas, doesn't it?
Absolutely. Clear diversification. It's not just the traditional engineering anymore. They're actively moving into higher growth, technology-driven sectors.
But it's not all upside, right? I saw mention of some impairment losses too.
That's true, and it's important to note they recognized impairments basically writing down the value of certain investments related to machine electronics and Aristovulos Energy.
How much was that?
About Arstein 19 core standalone, Arst 11 core consolidated for the last full fiscal year. The reason given was uncertainties related to future project potential.
So basically, some bets didn't look like they were going to pay off as expected.
Exactly. And recognizing that, booking the loss is actually a sign of good discipline, I think. It shows they're actively managing their investment portfolio and aren't afraid to cut losses or adjust valuations when future prospects look dim. It's proactive.
Right, better than just letting it sit there.
For sure. And one final point on the strategic front, just after this quarter ended, CG Power did a big capital raise.
Oh, yeah.
A qualified institutional placement, a QIP. They raised ours to 3,000 crore.
3,000 crore, that's substantial.
Very substantial. It basically means major institutional investors bought new shares, showing strong confidence in CG Power's prospects. And it gives that key subsidiary a massive war chest for future growth, acquisitions, or whatever they have planned.
Okay, wow. So a lot happening strategically alongside those financial numbers. All right, so let's try and pull this all together. We've done a pretty comprehensive deep dive into tube investments of India's Q1 FY26 results. We looked at standalone consolidated performance, those really impressive financial health numbers, and these significant strategic moves they're making. We saw, strong revenue growth overall, especially driven by subsidiaries like CG Power.
Yeah, the consolidated picture was really boosted there.
And that incredibly healthy financial position, super low debt, fantastic coverage ratios, just very solid footing.
Absolutely. And I think understanding these reports, it's not just about, knowing the revenue was X or profit was Y. It's about seeing the bigger picture. How a diversified group like TII, part of Morgapa, navigates all these different sectors, how they invest strategically, like in mobility and semiconductor,
Right.
and how they manage their finances with such discipline. It really shows how, even when things are complex out there, having focused growth areas and really solid financial management leads to resilience. It positions them well.
Definitely. It paints a picture of a company that's both managing its present very well and actively building its future.
So maybe a final thought for you to consider. When you see TII making these specific acquisitions, aluminum tubes for advanced HVAC, RF components, and pouring significant money into clean mobility. What does that really tell you about where a traditionally industrial engineering-focused group sees its future in this rapidly changing world?
Hmm.
Are they just adapting piece by piece, or are they fundamentally trying to reshape what TII is for the next generation?